Silver just broke through $83 per ounce. If you're watching this on Sunday evening, January 11th, 2026, you're witnessing history unfold in real time. Spot silver hit a new all-time record high of $83.96 earlier today, while gold simultaneously shattered through $4,600 for the first time ever. But this isn't just another price surge. What's happening right now in the silver market is something we've never seen before in modern financial history, and the implications reach far beyond precious metals. Let's start with the 24-hour price action. COMEX silver spot is currently trading at $83.96 per ounce, up 5.41% on this day. That's a gain of over $4 in a single trading session on a Sunday evening when markets are typically quiet. Gold is up 2.8%, platinum jumped 3.2%, and palladium is also surging. But silver is leading the charge, and there's a very specific reason why. The Shanghai Premium tells you everything you need to know about what's really happening. Physical silver in Shanghai is trading at more than $8 per ounce above COMEX prices. Let me put that in perspective. Under normal market conditions, regional premiums might be 50 cents to $1. $8 represents a complete breakdown of the normal price discovery mechanism. It means there's a scramble for physical metal in Asia that's so intense, buyers are willing to pay massive premiums just to secure delivery. And it gets even more extreme. In Japan and the United Arab Emirates, physical silver has been trading as high as $130 per ounce when COMEX was showing $72. That's an 80% premium. I'll say it again, 80%. This has never happened before in modern precious metals markets. Gold occasionally sees 5 to 10% premiums during supply crunches. But 80%? That's not a premium anymore. That's a complete decoupling of paper prices from physical reality. Now let's talk about what's driving this move, because it's not just one catalyst. It's a perfect storm of four major factors all hitting simultaneously. First, the Powell investigation. Late Friday, the Department of Justice served Federal Reserve Chair Jerome Powell with grand jury subpoenas threatening a criminal indictment related to his testimony about Federal Reserve headquarters renovations. On Sunday evening, Powell released an extraordinary video statement calling the investigation unprecedented and saying it's about whether the Fed will be able to set interest rates based on evidence and economic conditions, or whether monetary policy will be directed by political pressure and intimidation. Markets are interpreting this as a direct threat to Federal Reserve independence, and that's sending investors rushing into safe haven assets. When the central bank's autonomy is questioned, gold and silver become the ultimate stores of value. Second, China's export restrictions went into full effect on January 1, 2026. China now controls 60 to 70% of the world's refined silver exports, approximately 121 million ounces annually. Starting this month, only 44 government-approved companies with production capacity of at least 80 tons per year and credit lines exceeding $30 million can export silver. This effectively locks hundreds of smaller exporters out of the system. China has reclassified silver from an ordinary commodity to a strategic material, placing it on the same regulatory footing as rare earth elements. Elon Musk publicly stated that China limiting silver exports is quote not good unquote, highlighting how critical silver is for industrial applications including electric vehicles, solar panels, and advanced electronics. Third, the physical delivery stress on COMEX is intensifying. On January 7th, holders of 1,624 January contracts took delivery of 8.1 million ounces of physical silver, with JP Morgan issuing 99% of that total. What's remarkable is that despite this massive delivery, open interest for January actually increased by 1,431 contracts. Buyers are stepping into the futures market specifically to take physical delivery, not to speculate or hedge. They're using COMEX as a physical delivery mechanism because they can't source metal anywhere else. The problem? COMEX registered silver inventory stands at just 127 million ounces. If this delivery pressure continues, that inventory will drain rapidly. Fourth, the supply deficit is entering its fifth consecutive year. The global silver market faced a deficit of 230 million ounces in 2025. HSBC forecasts that will narrow to 140 million ounces in 2026, but it's still a significant deficit. Mine production isn't keeping pace with demand because most silver comes as a byproduct of copper, lead, and zinc mining. Even when silver prices surge, production doesn't respond quickly because mining companies make decisions based on base metal economics, not silver prices. Only about 28% of silver supply comes from primary silver mines. Here's what makes this situation so volatile. The paper silver market, the futures contracts traded on COMEX, is enormous compared to available physical metal. Billions of ounces worth of contracts change hands daily, but the actual deliverable silver sitting in vaults is measured in the low hundreds of millions. When large players start demanding physical delivery instead of rolling contracts forward or settling in cash, the system comes under extreme stress. That's exactly what we're seeing right now. The COMEX Silver Commitment of Traders report from December 23 shows something fascinating. As silver rallied 57.7%, hedge fund net long positions actually dropped by 41.8%. This isn't a speculative frenzy driven by traders. This is physical demand overwhelming a system built on paper leverage. Swap dealer short positions decreased by 31.6%. The big banks that normally provide liquidity by shorting silver are reducing their exposure because they can't source physical metal to back those positions. Let me give you the inventory snapshot. Western vault inventories have declined 70% since 2020. COMEX registered silver available for delivery is 127 million ounces. London vaults have seen significant outflows as metal ships to New York and Shanghai to meet delivery demands. Exchange-traded products continue to see strong inflows as investors pile into silver exposure. But here's the critical point, most of that ETF silver is allocated in London, and right now nobody trusts that the metal is actually there and deliverable. That's why physical premiums have exploded. The banks appear to be caught in a classic short squeeze. When silver hit $83 briefly on Tuesday before crashing 10% in just over an hour, many analysts called it obvious price manipulation. The crash happened during thin Australian trading hours before Chinese markets opened, with massive futures volume during a time when activity is normally minimal. It looked exactly like the manipulated sell-off that occurred in April 2011 when silver peaked at $49. But there's a crucial difference this time. In 2011, after the crash, silver kept falling for months. This time, silver recovered to previous highs within days. The physical tightness is so severe that any price dip gets immediately bought. Now let's talk about what happens next. HSBC just raised their 2026 silver forecast to $68.25 per ounce, up from a previous target of $44.50. Their analyst James Steele says silver is fundamentally overvalued at current levels but expects extreme volatility to persist with likely upside spikes as long as near-term tightness endures. He's forecasting a trading range between $58 and $88 per ounce for 2026, with price declines more likely in the second half as supply conditions improve. That's the establishment view. But many independent analysts think we're going much higher. Goldman Sachs warns that extreme silver price volatility is likely to persist through 2026, with China's export controls creating a risk of market fragmentation. Some technical analysts are pointing to $100 as the next psychological level, with longer-term targets of $150 to $300 if the short squeeze fully materializes. Bank of America released a note earlier this week suggesting silver could reach $309 per ounce under certain scenarios, though they later walked that back. Here's what to watch in the next 24 to 48 hours. Monday morning, Asian markets will open and we'll see how Chinese buyers respond to these price levels. If Shanghai premiums remain elevated above $8 per ounce, that confirms physical tightness isn't easing. We'll be watching COMEX delivery notices for February contracts. If we see another surge in delivery demand similar to the 8.1 million ounces that moved on January 7th, that's a signal the squeeze is intensifying. The US CPI report comes out this week, and if inflation data runs hotter than expected, that adds fuel to the precious metals rally. And of course, any further developments in the Powell investigation or statements from Federal Reserve officials could create additional safe haven demand. On the technical side, silver needs to hold above $80 on a daily close to confirm this breakout is legitimate. Support sits at $76 to $78, which corresponds to last week's consolidation zone. Resistance is obviously $84, the intraday high from late December. A clean break above 84 with volume probably opens the path to 90 and then the psychological $100 level. The volatility is going to be extreme. We could see 5 to 10% swings in a single day. This is not a market for inexperienced traders or people using leverage. If you're buying physical silver right now, understand you're paying elevated premiums. Dealers are quoting $85 to $95 for standard 1-ounce products when spot is $83. That's roughly a 10 to 15% premium, which is high but not unreasonable given the current supply squeeze. American Silver Eagles are commanding premiums of $12 to $18 over spot. If you're buying at these levels, you need conviction in the long-term thesis because near-term volatility could easily knock prices back to the mid-70s. The bigger story here isn't just about silver prices. It's about what this says about the global monetary system and commodity markets more broadly. When physical assets trade at 80% premiums to paper prices, that's telling you the paper market has lost credibility. When central bank independence is openly questioned through criminal investigations, that's telling you we're entering uncharted political and economic territory. When China weaponizes critical materials through export controls, that's telling you economic warfare is escalating. Silver happens to be at the intersection of all three dynamics right now, which is why it's moving like this. For investors, this creates both opportunity and risk. The opportunity is obvious. If physical silver continues to trade at massive premiums and COMEX inventories drain, we could see explosive upside. The risk is equally obvious. This is an extremely overheated market that could correct violently at any moment, especially if large holders liquidate to lock in profits. The smart approach is dollar cost averaging for those building long-term positions, keeping position sizes reasonable, and avoiding leverage entirely. One final thought. Markets like this don't last forever. Either supply catches up to demand and premiums normalize, or the system breaks completely and we get a true shortage where physical silver becomes difficult to source at any price. Right now we're somewhere in between. Physical is available but expensive, and the paper market is under severe stress. How this resolves over the next few months will tell us a lot about the integrity of commodity markets and potentially spark reforms in how precious metals are traded and delivered. That's the silver market update for Sunday evening, January 11, 2026. This situation is evolving rapidly and we'll continue monitoring these developments closely. If you found this analysis valuable and want to stay on top of the silver market as it moves, make sure to hit the like button right now and subscribe to the channel so you don't miss future updates as this story continues to unfold. Drop a comment below with your thoughts. Are you buying silver at these levels, or waiting for a pullback? Your insights matter and I read every comment. Thanks for watching, and I'll see you in the next video.